At the end of June 2026, 24-year-old Leopold Aschenbrenner appeared to be one of the greatest young investors Wall Street had ever seen. His hedge fund, Situational Awareness, had reportedly gained 439% in only 6 months. At one point, the fund's value was reported to be approximately $45 billion. But just a few weeks later, the same strategy lost 67% in a single month. The fund came under pressure from its lenders and was forced to sell most of its public stock portfolio to Ken Griffin's Citadel. So how did someone famous for predicting the future of artificial intelligence fail to recognize the enormous risk inside his own portfolio? And now that many of his stocks have rebounded sharply, was his AI thesis actually wrong, or was the real problem simply too much leverage? Aschenbrenner is a German-born AI researcher and investor with an exceptional academic background. He entered Columbia University at a very young age and graduated as the class valedictorian in 2021 when he was only 19. He later joined OpenAI's super alignment team, which was researching how humans could control future AI systems that might eventually become more intelligent than us. However, his time at OpenAI ended controversially in 2024. After leaving OpenAI, he published a lengthy essay series titled Situational Awareness: The Decade Ahead. That essay transformed him from a relatively unknown researcher into one of Silicon Valley's most influential AI thinkers. His central argument was that investors, governments, and the public were dramatically underestimating how quickly artificial intelligence was progressing. He believed improvements in computing power, algorithms, and autonomous AI agents could create another enormous jump in capabilities. From there, AI systems could begin automating AI research itself, compressing years of technological progress into just a few months. Whether that exact timeline proves correct remains uncertain, but his prediction had a very clear investment implication. More powerful AI would require an extraordinary amount of computing capacity, memory chips, data centers, and electricity. Aschenbrenner believed the world was moving from spending tens of billions of dollars on AI infrastructure to eventually spending trillions, and he thought Wall Street was still failing to appreciate the scale of that transformation. Aschenbrenner then turned that thesis into an investment firm named after his essay. Situational Awareness received backing from several prominent technology investors, including Stripe co-founders Patrick and John Collison, former GitHub chief executive Nat Friedman, and technology investor Daniel Gross. Trading firm Jane Street was also reported to be among its investors. This was extraordinary because Aschenbrenner understood AI, but he had very limited experience managing a large investment portfolio. Initially, however, his strategy worked remarkably well. The fund reportedly returned 47% after fees during the first half of 2025 and grew to more than $1.5 billion. Its success accelerated during 2026 as AI infrastructure stocks surged. The fund also used borrowed money and derivatives to magnify those gains. By the end of June, its reported return for the year had reached 439%. If you enjoy detailed stories about stocks, investors, and the numbers behind major market events, consider subscribing to the channel. What stocks did he own? Aschenbrenner was not simply buying Nvidia and the other obvious AI leaders. He focused on the less visible infrastructure needed to support AI. His disclosed investments included SK Hynix and SanDisk for memory and storage, CoreWeave and Nebius for AI cloud capacity, and Bloom Energy for electricity generation. He also invested in Applied Digital, IREN, Core Scientific, and other companies with access to power and data center infrastructure. One of his most prominent investments was Nebius. In May, Situational Awareness disclosed ownership of approximately 12.4 million Nebius shares. The position was worth roughly $2.6 billion at the time and represented approximately 5% of the company. The fund's first quarter filing also disclosed approximately $879 million of Bloom Energy shares, $724 million of SanDisk shares, $556 million of CoreWeave shares, and $401 million of IREN. However, the filing does not present the fund's complete portfolio. It does not show ordinary short positions, many foreign investments, or the amount of borrowed money. Some of the reported value also represented the underlying securities connected to options rather than the actual cash invested in those options. Still, the strategy was clear. Aschenbrenner was betting that AI would create enormous demand for memory, computing capacity, data centers, and electricity. On the surface, the portfolio contained many different companies, but economically they were largely the same bet. If investors remained excited about AI infrastructure, many of these positions could rise together. But if confidence weakened, they could also decline together. Owning 10 stocks does not create meaningful diversification when all 10 are influenced by the same underlying trend. What caused the 67% collapse? During July, several of the fund's major AI infrastructure positions fell sharply. These reportedly included SK Hynix, SanDisk, CoreWeave, Nebius, and Bloom Energy. But the fund was also hurt on the other side of its portfolio. Situational Awareness reportedly held short positions in software companies such as Adobe. A short position makes money when a stock falls. But instead of protecting the portfolio, some of these software stocks moved higher. Therefore, the fund's AI investments were falling while some of the companies it had bet against were rising. Both sides of the portfolio were losing money simultaneously, but even that might have remained manageable without leverage. Situational Awareness borrowed money through major prime brokers to control a portfolio significantly larger than its own capital. CNBC reported that its leverage may have reached as much as 4 times. To understand the danger, imagine a fund with $10 billion of its own capital controlling $40 billion of investments. If those investments declined by 15%, the loss would be $6 billion. The investments fell by only 15%, but the fund's own capital declined by 60%. That is how leverage converts an ordinary market correction into an existential crisis. Warren Buffett once shared a warning about leverage that fits this situation almost perfectly. He said, "A long, long time ago, a friend said to me about leverage, if you're smart, you don't need it, and if you're dumb, you've got no business using it." Situational awareness demonstrates exactly what Buffett meant. Aschenbrenner may have been intelligent enough to recognize the enormous opportunity in AI infrastructure before many other investors. His underlying investment thesis may even prove correct over the long term. But leverage left his fund unable to survive a severe short-term decline. As the fund's positions declined, its lenders reportedly demanded additional collateral. To raise cash, Situational Awareness had to sell some of the same stocks that were already falling. Those sales pushed prices even lower, creating further losses and additional pressure to sell. Aschenbrenner later compared the situation to a bank run, where vulnerability creates even more vulnerability. The fund also had another problem. Many of its largest investments were publicly known. Other traders could inspect its regulatory disclosures, identify the stocks it might be forced to sell, and potentially trade against those positions. Aschenbrenner said short sellers intensified the decline. That may be true, but using leverage with large and publicly identifiable positions was a risk the fund should have anticipated. In his investor letter, Aschenbrenner accepted responsibility and admitted that the firm had come dangerously close to permanent capital impairment. He also said the fund had now removed all leverage. With the fund under severe pressure, Ken Griffin's Citadel purchased the bulk of its public stock portfolio. Selling everything through one large negotiated transaction helped Situational Awareness avoid dumping each position separately into the market. That could have caused even more selling and considerably larger losses. But Citadel was negotiating from a position of strength. It knew that Aschenbrenner urgently needed liquidity and could potentially purchase the portfolio at discounted prices. Reuters reported that the public portfolio involved was approximately $16 billion. Goldman Sachs, JP Morgan, Bank of America, and Citigroup reportedly helped facilitate the transaction. After the deal, Situational Awareness was expected to retain approximately $10 billion of assets, including private investments and some unleveraged securities. Therefore, the entire firm was not liquidated. It sold most of its leveraged public stock portfolio, but it retained private investments, including a valuable stake in Anthropic. Here's where the story becomes particularly interesting. Once the forced liquidation was completed and Citadel took control of much of the portfolio, several of Aschenbrenner's major holdings rebounded dramatically. During the initial relief rally, Bloom Energy gained approximately 27%, Nebius rose around 29%, and CoreWeave gained approximately 24%. SanDisk also moved sharply higher. The recovery continued in subsequent trading. However, we should not attribute every part of these rebounds to the Citadel transaction. Bloom Energy, for example, had also reported exceptionally strong earnings and raised expectations for its business. Broader AI stocks were recovering as well. Nevertheless, the timing is significant. The rebound suggests that forced selling had pushed at least some of these stocks below the prices that willing buyers considered reasonable. Once the market realized that Situational Awareness no longer needed to liquidate more shares, the immediate selling pressure disappeared. This also means that Citadel may have acquired the portfolio at a highly favorable moment. But the rebound does not reverse the fund's losses. Situational Awareness had already been forced to sell. It could no longer fully participate when those same stocks recovered. And even a 30% rebound does not recover a large decline. If a stock falls 50%, it must subsequently rise 100% just to return to its original price. This is the cruelest part of forced liquidation. Was his AI investment thesis wrong? Not necessarily. Situational Awareness was not forced to sell because demand for AI data centers suddenly disappeared. It was forced to sell because its investments declined faster than its leveraged portfolio could tolerate. An investor can be correct about what will happen over the next 5 years and still lose everything before that future arrives. An unleveraged investor can continue holding a stock through a temporary 50% decline. A heavily leveraged investor may receive a margin call and be forced to sell at the worst possible moment. Therefore, this collapse does not prove Aschenbrenner was wrong about AI, memory demand, data centers, or electricity consumption. In fact, the rapid rebound in some of his holdings suggests that his stock selection may not have been the only problem. The larger mistake was combining an extremely concentrated thesis with substantial borrowed money and apparently leaving insufficient room for a violent market reversal. What happens next? The fund still faces serious challenges. Some investors may request their money back. Even though situational awareness reportedly remained approximately 80% higher for 2026 after the July collapse, many investors will find a 67% monthly loss unacceptable. Its relationships with lenders will also change. Banks will likely require lower leverage, more collateral, and tighter risk controls before providing the firm with substantial financing again. Aschenbrenner may also need to hire experienced risk managers, reduce the size of individual positions, and keep more cash available for periods of market stress. His remaining Anthropic investment could become extremely important. If Anthropic continues growing or eventually becomes publicly traded, that position could help preserve the firm's capital and support a comeback. Aschenbrenner has indicated that situational awareness will continue investing in public stocks, but without the leverage that created this crisis. Leopold Aschenbrenner's story should not be presented as the story of someone who knew nothing about AI. He is a highly intelligent researcher who developed an influential view of how artificial intelligence could transform the global economy. He converted that view into several highly successful investments and briefly produced returns that very few professional investors will ever achieve. But intelligence, knowledge, and conviction did not protect him from leverage. His fund owned different companies in different industries and countries, but many were ultimately part of the same AI infrastructure bet. When that trade reversed, leverage transformed falling prices into a liquidity crisis. The fact that Bloom Energy, Nebius, CoreWeave, and other positions rebounded after the forced sale makes the story even more painful. Aschenbrenner may still prove correct about the future of AI. His remaining Anthropic investment could even help him rebuild the firm. But after losing 67% in 1 month and surrendering most of his public portfolio to Citadel, the next chapter will not be about whether he can predict AI. It will be about whether he can finally learn to manage risk. If you enjoyed this video, please give it a thumbs up and subscribe to the channel for more detailed stock analysis. Thanks for watching, and I'll catch you in the next one.